Hey everyone, George here. So a lot of my contractor clients, since they're so handy, tend to have a couple rental properties that they manage and rent out themselves. So what I wanted to go over today, since this is such a tangential thing, like rental properties to construction itself, are the different IRS designations with respect to your rental properties and the unlocks that each one will give you tax wise and how to qualify for each level. So without further ado, let's get started. So the three levels that the IRS cares about with respect to your rental properties are active participation, material participation, and real estate professional status. Each level gives you different tax benefits, and depending on what level you qualify for, you may go from deducting only a certain amount against your ordinary income to deducting any losses against your ordinary income. So now the standard designation is that rental properties are completely passive income, meaning you can only offset passive activity losses against any passive activity income. So for example, if you have one rental property with losses, that can only be offset against the net income of the other rental property, the taxable income. However, if you have a loss between all your rental properties by default, you can't offset those losses against your ordinary income. It pretty much gets capped within its own passive activity loss bucket and rolled forward every year until it's used up. Now, the default is passive, which gives you pretty much no tax benefit whatsoever. However, what's the next level up? The next level up is active participation. Active participation is the entry level participation level where you must own at least 10% of the rental property and you make basic management decisions such as approving tenants, setting rental terms, and authorizing repairs. For active participation, you do not need to manage the property full time. You just need to have that 10% ownership and make some sort of management decisions with respect to the property. Now, what does our active participation get you with respect to taxes? It allows you to offset up to $25,000 of losses against your ordinary income. So while that might sound good, really there's actually even a phase out involved. So if your adjusted gross income is under $100,000, you get the full $25,000 deduction. If your AGI is between 100 to 150,000, it phases out pro rata. And if your AGI is over 150,000, then you get none of that $25,000 loss offset against ordinary income. As we all know, that 150,000 AGI is not a high bar. Most every contractor I know surpasses that very quickly from when beginning their business. So that really doesn't give us much to work with. So the next level up is material participation. Now, to qualify for material participation, the IRS gives you 7 tests, and all you need to do is pass one of these in order to qualify for material participation. Test 1 is you work 500 hours or more in the given rental activity. This is usually the cleanest and easiest test to pass. And mind you, for this test and every test that I'm about to go over, documentation is king. As always with the IRS, you should keep a log of the hours you're spending doing all this work. It doesn't matter how you keep the log. There's apps out there. There's Excel. You could use a notepad. Probably best to get an app and track those hours. So the IRS doesn't care exactly the method in which you're tracking it, but they care that you have a consistent methodology with which you're tracking it throughout the year. They don't like to see part of it is in Excel, part is in a notepad, part is in an app. That's going to give you problems. So, however you're tracking it, track it consistently throughout the year. And again, documentation is king. So sorry, I digress. The first test is a 500-hour test. This is usually the cleanest and easiest thing to pass. The second test is that you do substantially all the work, meaning you're the one doing most of everything on this rental property, rental activity. The third test is you work 100 hours and no one else works more than you. These first 3 tests I named, one of these should qualify you one way or another if assuming you pass them. The other 4 I'm about to name, they're in the statutes and they don't just apply to rental properties, they apply as a material participation test in the IRS statutes, though one way or another, the first three I just named, the 500-hour rule, the substantially all the work, or the 100 hours and nobody works more than you, like these are the easiest ones to pass. These are the cleanest ones to pass. I'm going to go over these next four real quick. There's a significant participation rule where you participate greater than 100 hours and the activity is significant participation activity, and all significant participation activities you participate greater than 500 hours for in the year. See, this is a little more complicated to hit. There's a prior year material participation rule where if you had material participation with any of these other criteria for 5 out of the last 10 years with respect to these rentals, then you would pass for this year as well. There's a personal service activity rule, which does not even qualify or doesn't really apply to rental activities. And there's a facts and circumstances rule, which is just a lot of gray area and a lot more difficult to qualify under. So it's really the first three that are the biggest things, the cleanest, easiest ways to pass. It's the 500-hour rule, the substantially all of the work rule, and the 100-hour rule, and nobody does more than you. So if you're going to qualify, one of these three should do it for you with respect to rentals. Now, we get to the meat and potatoes. Assuming you qualify for material participation, which is the second level up after active participation, what exactly does that get you? And that gets you the QBI deduction, which is actually not a bad deal. The QBI deduction gives you a 20% deduction of the taxable income from the rental property. So if you had, let's say, $50,000 of rental income, $10,000 of that becomes deductible to you right off the bat, assuming you qualify for material participation. So that's actually, to be honest, that's not too bad of a deal. Now we go to the final level, the holy grail of all rental activity designation, and that is the real estate professional status. Now, if you qualify for real estate professional status, you get to deduct all your any losses against ordinary income. So this is where you get to deduct, bonus depreciation, cost segregation, renovation expenses, interest, property taxes. All of this potentially not just offsets your rental income, would potentially offset your ordinary income as well, including W-2 wages, 1099 income, business profits, and most other taxable income. Now, how do you qualify for real estate professional status? There are 2 tests, and you must meet both tests. Number 1, you have to spend at least 750 hours in real estate professional activity. This includes time spent managing rentals, renovations, acquisitions, leasing, development, construction, brokerage, repairs, related bookkeeping, tenant communication, pretty much any activity that's related, could be construed as related to your rental activities or some sort of real estate activities. It would qualify as this type of designation. And you need to, again, documentation is king. You need to document your hours. If, God forbid you called for an audit, you need to show a very nice clean log of times and hours you spend, and they even could potentially look at your Excel file or whatever file and look at timestamps of when you made it. There are court cases out there where people made edits to their logs literally the night before the court case, and by that alone, everything was denied. So you have, just on an ongoing basis, keep a log and make sure it's got to be 750 hours or more in these rental real estate professional activities. And here is the kicker. So that was test number 1, 750 hours. Test number 2, this is where a lot of contractors might get disqualified. So you need to spend at least half of your time in real estate. So if you're working full-time in construction, this might disqualify you because you need to be spending at least half your time, in these real estate activities. Unless you can have a spouse spending at least half their time in real estate professional activities, you drastically reduce your construction hours, or you have a large real estate operation. So assuming you qualify for these 2 tests, 750 hours and at least half your time in these activities, you become designated as a real estate professional, and all your hours count towards material participation, meaning you're entitled to the QBI 20% deduction, and you would get to deduct any of your rental losses against ordinary income. Again, that could be W-2 income, 1099 income, business profits, what have you. It all could potentially be offset by any rental losses. So again, the three designations are active participation, which potentially at most can get you $25,000 loss offset, but there's phase outs. Material participation, which gets you the QBI deduction, which is not bad, okay, pretty good. and real estate professional status, where this is the highest level and you can offset any rental activity losses against passive activity losses from rentals against ordinary income. So I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.